Welcome to the St. Mary's County Retiree Benefits Trust Committee meeting. My name is David Weiskopf. I'm the County Administrator, and we'll start as we always do, which is roll call. Seated to my left,
Jeanette Cudmore, CFO, trustee member.
Catherine Pratson, Director of Human Resources and trustee member.
Dana DiGregorio, Administrative Recorder.
Thank you. And first up would be approval of today's meeting agenda.
So moved.
Second.
I have a first and a second. All those in favor signify by saying aye.
Aye.
Aye. Ayes have it. Motion carries. Next up is the approval of February 23rd, 2024 meeting minutes.
I move to approve the meeting minutes from February 23rd, 2023,
24.
or 24, excuse me.
And I'll second.
I have a first and a second. All those in favor signify by saying aye.
Aye.
Ayes have it. Motion carries. Next up is the presentation for the first quarter investment performance report by Mr. Patrick Wing.
Thank you, Mr. Weiskopf. Good morning again, everyone. So the cadence for this meeting will be similar to earlier this morning, but a couple other agenda items I'd like to walk through as well. So if you want to jump to page 4 of the deck here, as I mentioned earlier, we have some improvements in some of the performance reporting software that we use, so giving us the ability to cobble the data together a little bit more quickly. So I thought it'd be a good use of time to give you sort of a preliminary snapshot, and then when we meet again in June, the full report. But we'll be able to walk through that a little bit more quickly as we're covering some of the data here, and we'll follow a similar process later in the year when we meet in October and then again in December. But with that said, we want to start up top on page 4 in the summary cash flows. You can see the quarter to date, just a couple things to note. Where we began there, about $117.55 million. You'll note the net cash flow is a little higher than normal, and that's just because 2 of the fiscal quarters were withdrawn. I think the second quarter number was drawn just at the very beginning of January, and the third quarter right before the end of March. So it's a little higher than normal, but it's just how the reimbursements fell during the year. That net cash flow out about $2.47 million, more than offset by that net investment change. So all told for the quarter, the OPEB trust grew by about $2.6 million. From a return perspective, again, just a quick snapshot there in the middle of the page. You see quarter to date to the left, the OPEB's returned 4.3%. This does not include any of the private markets investments, as you know. We'll talk a little bit more about that shortly. We're still waiting on a number of actually year-end statements. So for right now, we've just adjusted their values with any capital calls and distributions in Q1. That said, where we stand right now, about 30 basis points ahead of that benchmark. Once we do get the private market numbers, we'll see the impact of that, as you all well know. As illustrated by the fiscal year to date, we've seen some downward revisions, over the past 12, 15, 18 months or so once we do get that data. And again, I'll provide you a little bit of an update here in just a couple of minutes. All that said, in the bottom table, as far as the asset allocation, we'll get into more granularity when we look at the recommendations, but always like to note all the way to the right in that bottom table, yes, up and down across the board. So we're in compliance with the investment policy statement at quarter end. If you look on page 5, it's a more granular breakdown of the summary of cash flows of the previous page, but a couple things I want to note in that net cash flow column. You'll see up top there a couple rows, partial redemptions from a couple equity managers, as you all well know. Given those reimbursements, we regularly have to raise cash to not just fund them, but in anticipation of future disbursements as well. So as markets that were gaining during the beginning part of the quarter made some recommendations or some partial redemptions, which were executed. As you work your way further down the page there, I'm not going to run through those numbers specifically, but each additional non-zero is either a capital call or distribution from the private markets in the latter half of that column. And then if you flip over to the next page here, what you'll see is that, again, in that net cash flow column, any non-zero, really in the first 2/3 of that column, is capital calls and distribution. So in Q1 in aggregate, we got back about $413,000 from the private markets investment. So in a perfect world, we'd get back as much as we need to disperse. As the programs continue to mature and get wound down, we should be getting, more and more money back over time, and that will help with the net cash flow. In other words, mitigate the amount we have to redeem from, say, equities and fixed income to meet those disbursements. The other key thing I'll note there, you see that large number towards the bottom third, that $5 million, if you recall, that was funded at the very beginning of the year. So it was a little bit of a calendar anomaly where the funds were raised right before the end of the calendar year because the wire for IFM wasn't due until January 1st, but it was funded at the beginning of the quarter. And then if you work your way further down the page there, you see the principal cash, obviously a larger number than usual because the money to IFM came from the Allspring Money Market Fund there. That was raised again prior to the beginning of this year. If we want to move to page 7, again, we'll get into the return data in a little bit more detail, make some comments on some of the managers. Again, mostly focusing on that QTD column, quarter to date, or in other words, quarter 1 of the calendar year. So again, the total fund returns are up top that we just referenced on the earlier page. And then in each darker row where you see composite, again, just synonymous with asset class, where it's a weighted average return of the underlying managers. So U.S. equities, for instance, U.S. equities, for instance, were up just a shade under 11%. You can see about a percentage point ahead of the benchmark due to some pretty strong performance by the active managers. So the first two there, those Schwab funds, are index funds in line with their respective benchmarks, as we would suspect. And then the final 3 gray rows are active managers within U.S. equities. So notably JP Morgan, the large cap growth fund there, up north of 16%, well ahead of its respective benchmark. Much of that due to an underweight in Apple. Apple comprises a pretty large portion of that benchmark, around maybe 10% or so, where JP Morgan only holds about a 3.5% weighting. And unlike the benchmark there for them, as you can see, was up 11.4, Apple was down around 11%. So about a 20 percentage point difference between how the stock did versus the benchmark. So if you're underweight something that does really poorly, then that's very helpful on a relative basis. So that and some other strong stock selection were helpful for them. Below there, you see William Blair. They marginally outperformed during the quarter, also helping relative performance. What was a bit of a detractor, you can see John Hancock, the small cap growth fund, was a little bit behind. And when we do see the peer rankings eventually, when we do the full report, I suspect the peer ranking actually won't be that bad. There was a pretty interesting market in the small cap, particularly small cap growth universe. You had 2 stocks, one called Super Microcomputer, which has really benefited from sort of this AI mania and craze that was up about 250% during the quarter. And another stock called MicroStrategy, more in the crypto arena, that was up another 150%. So again, like we've talked about in the past, if you have sort of these larger stocks driving the bulk of the gains, it's going to be a challenging environment, particularly for a manager like John Hancock that's sub-advised by a firm called GW&K that's more focused on high-quality, durable businesses, won't really hold those types of stocks. Now, this quarter, as we've seen markets take a little bit of a turn, those are the types of stocks that have done poorly. So now we're seeing them outperform in a down market, as we would expect. And then the non-U.S. equity, you could see also some slight outperformance. Dodge and Cox, the value manager, more or less in line. The key driver was really WCM. You see below there, actually pretty much double the benchmark. They had some pretty strong stock selection. I'm sure we've all heard about the weight loss drug phenomenon. They hold a key position in Novo Nordisk, which is the maker and distributor of Wegovy, and also ASML, which is a semiconductor chip maker, which has been sort of funding the AI craze. So this AI craze, they're these companies that are trying to build it into their business model are buying these semiconductor chips sort of hand over fist. And ASML is the manufacturer of those and provider of those has benefited from that environment. As far as emerging markets, you can see the combination of the active manager, Invesco, and Fidelity largely in line with the benchmark. I'll make more comments on Invesco later on. If you recall, we had recommended and the board approved placing them on the watch list at the last meeting. So we'll get into that update in just a minute. But as you flip over to the next page, not much to speak of on page 8. These are just the allocations for the private market funds. Again, we don't have the data yet. And then on the next page, on page 9, the first third of that page, you could see it continuing with the private markets where we don't have any returns, just the allocations. A couple other quick things to note here. You see infrastructure IFM was slightly negative during the quarter. Some of the interest rate volatility that we saw towards the end of last year and the beginning of this year filtering through valuations a little bit. Not necessarily, any problems with the underlying holdings, and we're still, very much a strong believer. If you recall, the SORP had made an investment a little more than a year ago, and I think it was up around 9% last year. So we would call more of an aberration than anything else at this point. And then finally, as it relates to performance, if you look at the U.S. fixed income composite, you see it was flat during the quarter, outperforming the benchmark by almost a percentage point. So a couple drivers. The first two names there, Delaware Diversified and Loomis, they are trying to outperform the benchmark, and they did so mostly due to holding more investment-grade corporate bonds than the benchmark and a small sliver in high-yield bonds, which outperformed, so that was helpful for them on a relative basis. But then the final manager there, Lord Abbett, was actually positive. Again, they're focused more on the short end of the curve. You can see the benchmark 1 to 3 years. So as rates moved up, putting downward pressure on bond prices, having them as a part of the fixed income portfolio means less interest rate risk for the combination here. So as rates moved up, the bond prices in aggregate were under less pressure because, again, we have less duration, meaning less interest rate sensitivity. So a lot certainly worked during the quarter. Again, this is a brief snapshot. In June, we'll have the full report. I won't repeat myself. So to give us more time to focus on some of the items not in here, and additional time to cover any other items that are on the agenda. So I think this sort of cadence moving forward will hopefully be a more efficient use of our time. So with that said, that wraps up the first quarter performance update. I'll pause there for comments and or questions.
And so do you want a motion?
Yes, please.
Yeah.
So I move to accept the first quarter update as presented.
I'll second.
I have a first and a second. All those in favor signify by saying aye.
Aye.
Aye. Ayes have
I
it. Ayes have it. Motion carries.
can't do two things at
I
once.
know.
All right, then. So moving on to the next few agenda items, and we'll be able to cover these in rather short order. Starting with the private markets update on page 11. Again, even though we are towards the end of April here, given the lag in reporting, particularly at calendar year end, when it tends to be even more extended, these data we're talking about Q4. That's why in the table in the second column after the asset classes, you see the 930 valuation, which essentially that number plus the capital calls less distributions plus the investment change gives you the quarter end to the right. Now, we do have most noted in the footnote. We have all private real estate. We have a little more than half of the private equity, and we have all the private debt. So it's a good snapshot here, really absent the private equity, where we're still waiting on a number of statements, but we should have them all when we get you these final data for the June report. All that said, just a couple quick comments, just focusing mainly on that investment change column. You'll see the first row for private real estate. We saw a downward move in the valuations to the tune of about 111 grand, which is not inconsistent. Sorry for the double negative there, which is consistent with the broader real estate market. So we look at that net investment change as a percentage of the beginning valuation. You can think of that as a rough approximation of what the return was, down a little less than 2%, where the broader real estate market was down on the order of maybe 3 to 4%. So on a relative basis, actually doing better than the broad market. Now, as it relates to private equity, certainly some moderation so far. Again, we don't have all the data, but downward or markdowns to the tune of about $100,000, which is just about 0.5% of that beginning valuation. We don't have that benchmark yet. That's actually going to be released this weekend. So we'll have it for the June meeting. And then on the flip side, private debt there, you can see positive investment change. This is an asset class that has really continued to perform well. If you recall, it's floating rate debt. So unlike the fixed income comments I made earlier, it's not sensitive to rate changes because what the lenders receive, which you are as an investor, right? You hold shares of a fund, the money's used to make loans. So you're indirectly, the lender here resets every quarter. So there's no interest rate risk. So as rates have risen over the past, however long it's been now, 2 years, the income you received as a lender has gone up. So it's been a pretty favorable environment. And that positive $53-ish thousand, about 2.4%. As far as the aggregate numbers in the bottom there, you can see the net investment change was not offset by the positive results in private debt. So about down 0.6% for private markets as a whole compared to the beginning valuation. So certainly a moderation from what we've seen. We still have a bunch of private equity yet to report, so that number's obviously subject to revision there, but a moderation sort of heading in the right direction. But that said, we'll likely get somewhat of a downward revision to the initial number we reported in February once we have all the statements and get you that final data in June. So with that said, I'll pause there for comments and questions before we continue with the final two items. Good? All right. So if you want to jump to page 13, I wanted to give you an update on Invesco. If you recall, this was an active manager in the emerging market space that we recommended the board place on the watch list in February, which the board did. A couple things to note. The top table, as we note in the title there, is just a reprint from the Q4 report to give you a little bit more context. And if you look all the way to the right, you'll see since inception, and going back 13 some odd years now, they've done reasonably well on a relative basis. Obviously, the emerging markets as a whole have been somewhat of a challenging space by those absolute numbers. However, a lot of the outperformance over that period was generated years ago, because if you work your way from right to left a little bit there, you can see in the intermediate time frame, they've been consistently behind the benchmark. So we have an update in that bottom table. If you recall what I showed a second ago, they were about 20 basis points behind the benchmark in Q1. That's gone up to about 130 basis points now, meaning that in those 2.5 weeks through the close of business this Thursday, they're behind by about a percentage point. So it would be my recommendation that we bring a search for the board to consider in June. So if you recall, normally how we present these is we'll profile the current manager, Invesco, and a couple other options for a potential replacement, just given the performance. Obviously, over the intermediate time horizon and more recently, we haven't seen any improvement. So with that said, I'll pause for comments and questions.
I think
It's a good recommendation.
Yeah,
Okay.
I think so.
All right. And then one other quick item here, page 15 with the recommendation. So a couple quick things to note before we get into the details. So the total assets there, you can see about 116.75, down about 3.4 million since the end of Q1. As I mentioned earlier this morning, we've seen a pretty decent reversal in equity markets this quarter, unlike those strong gains in Q1 on the back of some uncertainty around the path of inflation, which markets took in stride in Q1, but have become susceptible to a little bit more recently. And as far as the impact on the asset allocation, we'll get to in just a second when we talk about the post rebalancing. But as I mentioned earlier, normally we might approve this disbursement at our June meeting, but again, that falls on the last day of the calendar quarter. So in order to kind of clean things up, we are recommending two things and then a sourcing from cash to fund the reimbursement. And under the rebalancing column, what we're projecting to come out is simply the previous quarter's reimbursement. It might be higher, might be lower, just using it as a proxy. So with that said, we are recommending partial redemptions from the S&P 500 index fund from Schwab and the Schwab Large Cap Value Fund of $450,000 and $150,000 respectively. Even though markets are down a little bit more recently, we still have seen strong gains so far this year and a big rally since really the beginning of Q4 last year. And prior to taking into those redemptions into account, if you look at the top table to the right there, and I know that you have to squint a little bit, but that first row U.S. equities were still a little bit overweight despite the recent weakness. So that would generate about $600,000 in cash, and then we recommend sourcing the remaining disbursement all the way down at the bottom from the money market fund. And in turn, right to the right of that, that would leave us with about $2.6 million in cash, essentially another 2 quarters. And just another couple quick comments here. You know, if markets had ramp higher, we'd probably recommend a little bit more out of equities, you know, sell high to generate these needs we'll need into the future. But this is something we're going to continue to have to be cognizant of, because it's my understanding, and Ms. Cudmore, correct me if I'm wrong, for the next fiscal year, like this one, we're still going to be just drawing from the trust. There's no contributions.
Correct.
So again, you know, if you think about the dynamics, you know, assuming this rebalancing is roughly in line with what's going to occur, we're talking about $4.5 million, which is about 4% of the trust.
It's actually, the amount anticipated is about $6.1 million.
6.1. So
For
even
next year.
even higher.
Yeah, because their health rates went up,
The benefits,
yep,
Yep. So
2.25%.
So even higher. So what that means is having, you know, not holding any, or excuse me, holding a decent amount of cash, generating some when times are good to mitigate the risk of having to generate cash after markets have already declined. So with all that said, I'll pause there for any questions or comments around that recommendation.
Just thinking about the timing of the last payment.
right. So what we'll need to do is, once that June Care First bill is processed for the
Okay.
retirees,
Yeah.
then we can actually, we'll have the final amount for the year.
Okay,
And then we can go ahead and submit the reimbursement request.
Okay,
So I have to check. I'm not sure if it was in this check run or if it was in the last, but I'll go and check and see which one, where we are.
Yeah,
Because
we wouldn't
normally
have-
the June is processed in May, right?
right, so we wouldn't have processed
Not
June
yet.
Yeah, but I'll track that.
And as
So
soon
I
as
can let
you
them- okay.
process it and get it in the check run, then we can go ahead and, that'll be the final number,
Yeah, it's likely mid-May,
mid-May,
right?
yeah.
So if the board does approve this, obviously these actions are not particularly time
Right.
sensitive. You know, just something to execute eventually if approved, and obviously clean everything up prior to
Right.
the end of the fiscal year.
Right.
Yeah, that'd be great. Yeah, I move to approve the rebalancing recommendations as presented.
I second.
I have a first and a second. All those in favor signify by saying aye.
Aye.
Aye. Ayes have it. Motion carries. Thank you, Mr. Wing. Next up is the Plan Administrator Report for April 25th, 2024.
Yes, and I will be covering that for Joy as she's in training today. So the capital calls that were made, transfer of funds totaling $96,500 since the last meeting, was for the ABR Chesapeake investors at $80,000 and JMI Equity Fund for $16,500. Administrative items, transfer of funds totaling $1,148,976 since the last meeting. $25,678 went to Marquette for July through September 2023. $25,232 also went to Marquette for October through December 2023. Principal administrative fee, December 2023 to February 2024, $7,256, and then the fourth FY 2024 reimbursement of the third quarter expenses of $1,090,809. And as we have already discussed, the fourth reimbursement will be done probably mid-May to the end of May, after we have the Care First bill. The following meetings are June 28th, August 23rd, October 25th, and December 6th. And as also discussed, for FY 2025, we are not funding, not the ARC, the ADC, because we were at 95% funded as of the June 30, 2023 audit. So the commissioners made a decision not to fund that, but we are using the trust monies of approximately $6.1 million for FY 2025. And then we would do that the same as quarterly reimbursements to the county, which will be about 1.525 quarterly.
Thank you.
And I'll move to approve the plan administrator report.
Second.
I have a first and a second. All those in favor signify by saying aye.
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 Aye. Ayes have it, motion carries. Ms. Cudmore, would you like to make the last motion?
I can. I move to adjourn the meeting.
So moved.
A first and a second, all in favor signify by saying aye.
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 Ayes have it, motion carries. Thank you, everyone. See you.